One segment that has done very well lately is the chemical space. Now, despite the rise in chemical prices, the demand has not risen as much in the domestic and the export markets, but it's interesting that the stock prices have risen. So let's find out more. Ranjit Cirumalla, who's the Vice President Research, Agri-Chemicals and Mid-Caps at IIFL, joins us now with the call on the chemical sector. Ranjit, thanks a lot for joining in. First, if you can tell us, why are the stock prices rising so much? Is there a pickup in demand? And from your coverage universe, the stocks that you track, where is their maximum potential, both in terms of valuation and growth?
Yeah, thank you. Good morning, all. What we have noted is that there has been a rally in the chemical prices over the last few weeks, and that was more prominent over the last 1 week. We note that this is backed by a bit of lesser aggression by the Chinese player. What we have seen over the last few months, Chinese market has always been difficult to predict how they behave. They have cut prices significantly from March, April. And over the last 1 week or 15 days, we have seen a bit of lesser aggression. And that is what has led to a bit of recovery of sorts in the chemical prices. But at the same time, the checks do indicate that this is not backed by the volume recovery, and to that extent, the demand remains a bit of subdued, and it's difficult to kind of predict whether these kind of a rally is sustainable. We believe that the companies that are exposed to these bulk chemicals is what have reacted to this price rise in the chemical.
All right. Hi, Ranjit. Good morning. Good to have you on the show today. Ranjit, prices have moved up, and yesterday stock prices as well moved up. But otherwise,
Right.
It's still a far cry away from the recent peaks. Your view on the stocks at current valuations, and also demand has not yet picked up. So by when are you penciling in some kind of demand pickup?
Yeah, so we have recently concluded the earnings season. Both we have tracked the domestic and the global, and the commentary across the board has been that there has been a destocking phenomena, and most of the managements have indicated that it would last for at least for next couple of quarters. So December is what we are expecting a bit of green shoots to start getting visible, and then from the 4Q of FY20 onwards, there is an expectation that the demand would start recovering. The destocking has begun. It's been just a couple of quarters. That should see through for the next couple of more quarters. And that's where we will see a bit of more pain, probably that the companies might have to go through. This looks to be a bit of more transitionary as this point of time. And we are keeping our eyes on when that volumes would kind of start recovering. So if you look at, most of the street has kind of a cut-off estimates for FY24, but we are still penciling a recovery in the FY25. So we haven't cut much on the FY25 estimates. From the valuation perspective, if you look at, there has been a bit of healthy corrections in the bulk chemical space, and that is what we have seen in the last 10-15 days. There has been a recovery in those names. But on the spec chem side, we haven't yet seen any meaningful correction. So there we have seen a bit of both getting removed, probably at a 35 times multiple has now come down to 30 times. So we await a better entry point for the specialty chemical names. We do feel that there would be a point in the next couple of quarters, we would be able to get a better entry points in these names.
So, that was the question that I had for you, that if valuations are looking a little attractive now, what is in the coverage universe, which are the stocks where you're keeping an eye out on, where perhaps you could buy, maybe not now since you're expecting better entry points over the next 6 months or so?
These we have been highlighting that India as an outsourcing destination continues to attract more and more outsourcing. So the likes of SRFs, the ones which have got into the contracted business, the spec chem side, I don't want to name any specific companies at this point, but clearly there are the set of companies that are largely focused on the contract manufacturing that should do well over the next 3 to 5 years period.
So, which names, sorry, Ranjit? What are your top ideas?
Yeah, so I have been having this view that the valuations are not yet comforting, though there has been a bit of fraud that has got removed, but they are not yet in a buying zone. But at a right attractive point, we will definitely look at companies like SRF.
You cover other agrochemical names as well, Ranjit?
Yeah, I do cover. We have a coverage from.
Right. Very briefly, this new emerging story, which is getting more and more traction, is, of course, shortfall in rainfall, right?
Right.
Which is in August has been very, very severe, and I think the overall season is also some 9-10% deficit now. What does it mean for agrochemical companies? Are there any implications?
So when you
Briefly,
talk about
yeah.
agrochemicals, there are largely in the three buckets. If you want to discuss on the domestic agchem companies, what we have seen is that there has been a channel push from 1Q to 2Q. So 2Q should definitely be a better quarter for the companies that have an exposure to the domestic market, the Indian market. And 2Q, second quarter has always been the liquidation quarter. So to that extent, what we have seen in the earlier part of this quarter, there has been a healthy liquidation that has picked up. But August definitely, as you highlighted, has been a bit of a dry spell, and that momentum has kind of a slowdown. For the exports market, the CSM side is what is still doing well. And for companies like UPL, which has a global exposure, I think the 3Q and 4Q is what's going to be the key quarter for them. And for that, it's a bit too early to take a call.
Okay, all right, we'll let you go on that note. Thanks a lot, Ranjit, for joining in.